Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome Ryan Barker and Ken Favaro. Thank you, Ryan and Ken, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg, for having us. Appreciate it.
Great to be here, Greg. Great to see you too.
Thanks, guys. Ryan Barker is the CEO and founder, and Ken is Chief Strategy Officer at BERA.ai, a SaaS platform that gives researchers, marketers, and brand builders the data, analytics, and insights they need to maximize their ROI and contribution to business outcomes. The firm connects brand strategy to business outcomes, enabling you to measure, predict, and optimize the financial impact of your brand all in one place. With AI-powered insights, census-matched data, and predictive analytics, BERA.ai helps you make smarter decisions, prioritize high-value audiences, and drive measurable growth. From tracking brand performance to refining media strategies, BERA integrates brand data into your marketing ecosystem and delivers the intelligence to outmaneuver competitors and maximize ROI. By the way, Ryan joined me last year on episode 7 of this Create More Value podcast, where we discussed how brand investments create value. In this episode, Ryan, Ken, and I will focus on and explore the brand implications for companies facing activist investors. To set the stage, I want to tell a story I've mentioned in articles, speeches, and even in my book, Curing Corporate Short-Termism, Future Growth versus Current Earnings. Consider the case of the activist investor Trian Group and the H.J. Heinz Company. The asset management group condemned Heinz's management for putting too much money into trade allowances and promotion to drive short-term sales and profits while neglecting the advertising and product innovation that would nurture differentiation, long-term brand value, and stock price. After a failed proxy fight and acceptance of some new board members, Heinz acquiesced and increased its advertising budget. With such a strong emphasis on making investments that provide long-term brand benefits, potentially at the expense of sacrificing near-term results, this was certainly not the old story of short-sighted activists pillaging a venerable company for immediate gain that has become so common in the business news. This is a great story, and there are some very good activist investors out there like Nelson Peltz, founder of the Trian Group. Unfortunately, there are many activist situations where brands are put at risk as brand building investments are cut, either to boost margins or to reallocate the funds to short-term promotion. It is this type of activist situation we are here to talk about today. So first, before we get to the activist investor topic, Ryan, can you familiarize our audience with how BERA measures brands and drives better planning and decision-making?
Yeah, absolutely, Greg. So at BERA, we measure in real time perceptions of brand across 5,000 brands in total, 200 sectors on 130 metrics that matter. It's survey-based, it's in real time, it's census matching, and it's down to the zip code at the respondent level. What's really key here, Greg, is that we're measuring leading indicators of brand as opposed to vanity metrics, which a lot of folks unfortunately have to leverage, and we talked about on our last call. I think it's important to note the way we define measuring overall equity, the BERA score, or call it brand love, is really a construct of 4 dependent variables. We're looking at the degree that folks are familiar with a brand. We look at the degree folks hold a brand in low to high regard. We look at the degree that respondents find the brand meaningful and relevant in their lives. And last, we look at how unique and differentiated is that brand to the individual. And those are the 4 leading indicators when we look at equity.
Okay, thank you. Turning to you, Ken. Let's start at the top. Why do you think activist investors often get a bad rap, especially in the context of companies with strong and important brands?
Yeah, well, I think that as a group, they are often perceived to favor their own interests over at the expense of a company and its long-term health. But in my humble opinion, that's painting with a really broad brush. There's no company out there that's perfect. And often the leaders of a company will have blind spots. And sometimes it needs a third party who's very interested in the company to help leaders spot the blind spot and to address it. I see 3 kinds of blind spots in my work with leaders over time. which I kind of put into three broad categories: strategy, are we making the right choices for the company? Implementation, are we implementing those choices effectively? And execution, are we getting the results that we expect from a well-implemented strategy? And there will, from time to time, be blind spots in a company, whether it's strategy, implementation, or execution, that an active investor can help leaders spot. A good activist will spot the right blind spots and help leaders address it, and a bad one will either think that there's a blind spot when there isn't one, or just choose the wrong one. I think Elliott is a good example of spotting a strategy blind spot at British Petroleum. They really struggle with getting the right strategy, and as we go through the energy transition, and I think they drifted a bit. And I think Elliott's I think they're spot on in terms of challenging the BP leadership to think harder about what their strategy is going to be and how they allocate capital accordingly.
And Ryan, why do you think the Heinz case I discussed before is the exception? Based on your conversations with chief marketing officers and other executives, what usually happens to brand investments when an activist shows up?
Yeah, great question. And we've had the luxury of getting approached by both sides of the equation. I think it's not that Heinz is the exception. I think it's the activist investor that is the outlier here, approaching the brand and saying, you're not spending enough in advertising and brand building. Typically, what would happen is when the activists come in, the first thing folks say is, let's go kill investment in brand. Let's go kill investment in advertising. And quite frankly, it's because of a couple of things. First, most folks think of brand as this intangible, hard to measure asset. There's a misalignment from the timetable. Activists are coming in for short-term gains and cost cutting, and people put brand in the long-term bucket. They don't believe there's a short-term contribution. And third, they think of brand as an expense when if they actually had metrics that matter, it's one of the most important assets to measure, manage, and maximize. I think in the Heinz case also, Nelson was really interesting. If I could paraphrase him properly, he's like, we didn't come in to kill marketing and cut budgets. It's to make it work harder. And he was sort of ahead of his time in terms of what we're doing today with software and big data and AI is it's an optimization game. How do we get rid of and minimize waste and quantify metrics that matter for short and long-term contribution?
I think it's a great example of a blind spot that management had, which an activist investor was able to identify and come in and help management see something that perhaps they hadn't seen before.
Yeah. You talk about eliminating waste, Ryan. So well over 100 years ago, John Wanamaker supposedly said, half the money I spend on advertising is wasted. The trouble is I don't know which half. Ken, I know you have quoted this in your writings. It's a great quote, but it's really dated, right? I mean, can companies be more surgical now in knowing where they're getting a good ROI on advertising and where not?
Yeah, well, the answer is a strong yes, subject to caveat. We love the quote too. In fact, we quoted it, as you mentioned, or alluded to in the article we published in HBR last year on brand building and performance marketing, which is a big issue now in the marketing world. But our data and analytics proves really conclusively that if you are advertising to the right audience, let me come back to what the right audience is, your advertising is going to be really productive. And the audience is for whom your brand is meaningful and unique. Remember the two of those four variables that Ryan alluded to earlier. The ones that really drive propensity to buy, disposition towards your brand, pricing power of your brand are meaningfulness and uniqueness. And you can identify audiences now based on how meaningful and unique they perceive your brand to be. And it's advertising to them where you can really get a great return on advertising. But advertising at a lot of companies amounts to one of two problems or both. One is spray and pray, otherwise known as reach advertising, right. Reach as many people as you can, or hope springs eternal, otherwise known as, go after the people that are in your category and ready to buy, whether they like your brand or not. They're in the category, they're ready to buy, go after them. That's often called performance marketing. And for them, the Wanamaker quote is, his lament is as true as ever. Broad reach, spray and pray, hope springs eternal is going to amount to at least 50% of your advertising going to waste, which is the opportunity and the blind spot that Trian saw with Heinz, correctly so. Fortunately, since Wanamaker's time, two things have become possible that can change the equation completely. One is you can measure brand equity at a very granular level, even down to the individual now. The technology is available, the data, the analytics are available to do that, and you can target your advertising at a very granular level thanks to the proliferation of so many media channels. So you can figure out, well, who's open to my brand? And you can get to them very cost effectively. And you can figure out who's not open to my brand and suppress that audience. Don't spend money on that. And you can know with much greater certainty which half of your marketing or advertising is productive and which half is wasteful.
Yeah, that's really great. That's fantastic innovation. And, we see these days the use of AI, big data, and so forth in so many different areas. And I think you guys have just done a great job in applying it to understanding, how to best go after making a brand more valuable. So I've co-authored 2 articles titled "Be Your Own Activist," which I think is one of the better titles of an article I've ever come up with the premise that executives should look at their company as an activist would before any activist arrives. If you can identify initiatives an activist would demand that make sense, why not do them now? Why wait for the activist? And for demands that don't make any sense, prepare your response now so you're ready. If an activist does show up, they show up at 10 o'clock in the morning, at 11 o'clock in the morning, you have your response because you've already studied and what things don't work. Ryan, how can companies embrace modern brand management tools as part of being their own activist?
Yeah, great question. So we often talk to our clients in terms of 3 M's. There's measure, manage, and maximize. So Ken already alluded to, first, when you talk about measuring equity, it needs to be real time with the same granular that folks want for financials. So you measure brands down to the zip code, respondent level, matching census. Manage, it's really crucial that you are benchmarking your brands against culture. And what I mean by that is you're not just looking at you versus your category. You could be the top dog in a category tanking, and you'd have no understanding that you're tanking. You need to benchmark against culture. And then maximize is really the ROI game, is how do I optimize the role of brand as an asset, not an expense, to hit any business metric. So let me double click on that for a second. If you have sales as an objective or share as an objective or profitability, and you have access to that financial data, you can connect it in software with brand equity metrics at high resolution and understand and prove the causal linkage between investment and brand as an asset is a predictor to business outcomes. And that's really what folks want to understand. That is brand actually an asset that I can count on to deliver financial returns? Here are 3 examples of brands that have done a great job of optimization. Take Celsius energy drink. They optimized by doubling down on a target, Gen Z and millennials. They ignored or didn't spend the lion's share on other additional periphery audiences and did a phenomenal job of growing their brand equity, their brand love, and crushing it. And US is one of the largest sources of income. Take Loki sneakers. You might have heard of it. It's only 2 to 3 years old. And in a short period of time, these guys have optimized by channel. They focused on TikTok, for example, connected with celebrities as other brands that can address perceptual weaknesses while reinforcing strength, and just crushed it in a short period of time of taking a page in the fabric of culture. And then the last one, take Mattel Barbie. I think Barbie's as old as Ken, 60 plus years old. And here's an old brand that they've managed to revitalize by stretching the brand into new adjacencies. And a year and a half ago, already had an Oscar-winning movie, which completely rejuvenated and brought life to this brand, not just with the original families that grew up with it back in the day, but multiple generations. So you can optimize by target, you can optimize by channel, you can optimize your positioning, you can optimize against culture. It's really those 3 components.
Yeah, I mean, one of the things that I always admired when I first met you and learned about BERA some years ago was the way you benchmark against all of the brands and not just against the category. Because you could be the best in your category, but your category could generally be full of terrible brands. And you don't notice that when you only benchmark against your own category. So I think that's really good. So brand value doesn't show up on the P&L, but the investments in building brands are expensed against the current profits. It's unfortunate. I mean, when you invest in buildings, you get to depreciate them slowly over time, but you invest in a brand, you have to expense it all right now in accordance with accounting principles. Ken, with the executives under pressure to hit earnings per share targets from investors at large, and especially from activist investors in some cases, how do you convince management not to cut what looks like discretionary spend? And how do we get the activist investors to support this?
Yeah, well, first of all, brand value may not show up on the P&L, may not show up on the balance sheet, but it certainly shows up in your stock price. It's what accountants call goodwill.
Mm-hmm.
And CFOs are taught to be really skeptical of goodwill.
Mm-hmm.
And that's kind of the challenge that marketers face. And so they need to build a compelling business case that a CFO can understand. And that, in our world, that entails three things. When we work with CMOs to help them build a business case, we do help them do three things. One is just quantify the directly attributable contribution that brand has to your stock price. It is quantifiable in a very robust, defensible way. The other thing you can do is say, if I grow my brand by this much, how much will my stock price increase?
Mm-hmm.
You can quantify that in a very defensible way. And if you can do that and you can link it to, well, how much would I need to invest in order to grow my brand by this much?
Mm-hmm.
Voila, you have an ROI that a financial guy can understand or woman can understand.
Mm-hmm.
In fact, you can compare it. We've done this. We've compared the ROI of brand building to the ROI of other corporate investments, whether it's, investing in a new line of products or putting a new factory in. In one case, it was about creating more branches for a financial advisory firm.
Mm-hmm.
You could show that investing in brand produces an ROI that's well above the average corporate investment.
Mm-hmm.
Because when you increase brand equity, by definition, it's increasing your meaning and uniqueness, and people gravitate towards that. They will start to buy your products and services. It gets an immediate material impact on your sales. But more importantly, it increases willingness to pay, which is what your pricing power is all about. So you put those two things together and you can get a really good ROI investment. But if you've not done that before the activist comes knocking at your door, it's probably too late. At that point, you're just scrambling and trying to backfill. So, we would advise every CMO, get on the front foot now. It'll help you with your CFO. It'll help you with your C-suite. And should an activist, ever come knocking, it'll help you with them as well.
That's really great. I'd like to just add to that a little something from our research using your data. And it was, again, going back to when we first started to be exposed to BERA and your insights on meaningfulness and uniqueness and so forth. And one of the things we found interesting was the strong relationship between your metrics and valuation multiples. When you spend money on advertising, if you increase your advertising budget, it weighs on your EPS. And it's offset by the sales you generate now, but it's even more offset by the sort of repeat purchases that come from building the brand, which you don't always get with short-term promotion. And that's why the multiple expands. And I've always felt that, taking financial information and your brand stats together on a scorecard gives you a real value-based perspective, all using factual data. There's no forecast, there's no MPV. It's all using, sort of spot data. So, I think that it's really a valuable tool to have your data side by side with.
Yeah, if I could offer a nuance on that, certainly that you will get multiple expansion because Mr. Market sees that stronger brands probably have a better future for growth and a better future for pricing power. And that's what they're investing in. That's why there's fundamental reasons for it. It's not voodoo. Yep. But here's the nuance, which is in some categories, the lag between when you've improved your brand equity and when it shows up in your sales and your pricing power is less than a year. So there really is no short-term trade-off there. Right. If your frequency is annual. Yes, there are some categories where that lags a little bit longer. It seeps into the next year, in which case you do have a this year earnings trade-off versus multiple expansion. But for a lot of categories, the immediate impact on your top and bottom line is under a year. So it really is no short-term, long-term
Yeah.
trade-off that, makes it so difficult, particularly for marketers,
Right.
to justify that investment in your brand as
Yeah, no,
a
it's
asset.
you're getting the top line, you're getting the bottom line, and you're getting the multiple. It's really a pretty
That's
good.
why that's that ROI that I alluded to. That's
Yeah, that's why it's so
usually
high.
pretty competitive with other corporate investment opportunities that a company has.
Sure.
If I could double click on one quick piece. So with the tariffs now in play, this is one of the top questions that folks are getting. And if there's activists in play today, take the tariff on top of the degree folks are willing to pay a premium. How do you even sustain your sales? So if an activist is coming in to cut costs, what about the profit potential of the ability to increase your price? And they quite often fail to have the proof point on how brand can directly increase your pricing power. And that's part of the reason why we measure price elasticities in real time to help remove that blindness.
I'm sorry to double click once again on this, but I've had an experience just in the recent triple click. Just in the recent weeks, I had an experience which is kind of interesting. I went to two different conferences. One had a lot of med products companies and other very differentiated companies represented by their finance officers, and another one a couple of weeks later was more industrial people with products that were less differentiated, more tough competition. And the point of view on the tariffs was like night and day. The first group was like, well, we're just going to add it onto our price, and that's going to be that. And they're so differentiated. People, if they want their product, are just going to pay it, and that's that. When you went to the next group, where you had people that had hardly any differentiation at all, they were all panicking. If we raise our price, our volume is going to crash. And so there's, it's a real trade-off there. So the brands have a big impact on the ability to withstand all kinds of shocks, but certainly a shock like an unexpected, very significant cost like a tariff.
We were in a meeting with the CMO of a car company the other day, and we were talking about how you can link brand equity to pricing power, and therefore you can increase your share without having to drop your price, or you can increase your margin without sacrificing share. Every hybrid in between. And they asked a great question, which is, with tariffs coming, how much would we have to increase our brand equity in order to offset the demand or margin effect of tariffs? It's a great question. And we're now getting that asked almost weekly.
Wow. That's good. Oh, that's good. That's actually a good sign that they're asking that question, because that's the right question, right? Yeah, that's good. So Ryan, let's get very practical now. Say management is sitting down with an activist investor. How do they actually start the conversation about protecting brand in an environment where that might be hard to do?
So you'd approach the activist and you'd ask them today, in your playbook, is brand part of the equation? And if they say no, you ask why. Step 2, you show them your playbook where you've already quantified brand's contribution to the bottom line. For every 1 point increase in equity, what happens to sales, share, profit. You're able to show for every dollar spent in brand investments, how you're already optimized by channel. You show them that dollars you're spending on targeting, you're only going after high ROI audiences that are open to the brand and suppressing those who may be in the category but want nothing to do with you. And so therefore you're coming in showing them that brand is an asset, not an expense, and you're quite disciplined on its economic contribution. And then 3, the case studies like what Ken just mentioned, and there's no shortage of other case studies to quantify this. It's about having a fact-based conversation, not an opinion.
And I would say that what Ryan just talked about is the conversation that the CMO should be having with the activist. And if I were the CEO, I would bring the CMO into that conversation. I mean, part of the big issue is that the CMO doesn't have a chair at the table where management and the activist investors are talking, and that makes their marketing budget somewhat vulnerable. If you don't have an investor like Tryon that kind of knows what they're doing, knows what the importance is of marketing for building brands versus just, fettering away your brand through discounting and short-term promotions.
Here's a quick stat if we're talking about just the advertising spend and optimization. When folks are putting brand into these media mix models, Greg, you have something called base sales, which is if you turn off your advertising today, what will sales be? And then what's brand's investment on top of it? The reality is most folks, when they're doing these media mix models, they haven't properly put brand in the equation. And what we found across 200 sectors is on average, brand is actually contributing to 5 to 30% of what folks were thinking are base sales. And so let alone reducing advertising spend. So we got to get clear on how much brand is contributing to short and long-term contribution. It is not correct to say that brand is only about tomorrow.
That's great. That's great. So Ken, we're discussing how activist investors can adversely affect brand building investments. Are there similar pressures on innovation spending, another form of like intangible investment? And should those expenditures be treated any differently in how people think about them?
Yeah, well, first of all, I would say any investment, whether it's tangible or intangible, is vulnerable when management can't really substantiate or defend its ROI. And that's true whether the investment, is on the P&L or whether it's on the balance sheet. As for innovation, I like to think of innovation as solving problems with superior solutions. Superior meaning it's better than any solution that's out there. And if management can show that their investment spending is going against some compelling problems, number one, and number two, that they actually have some compelling ideas or great ideas for solving those problems, I think their investments in innovation, regardless of the type of the problem that they're investing innovation against, is very defensible. I think it's that simple. The problem is that isn't necessarily how activists or management think about innovation. And they don't necessarily cast their innovation investments as being about solving problems and then defending those investments by showing that they have really great ideas. Great meaning they're superior solutions and you can make a lot of money with those solutions.
One of the problems I see is that you don't have the same kind of data to back up your ROI assertions as you have with brands using a framework like yours.
Not only that, but almost by definition, if it's a really great idea, meaning it's really innovative, it's new to the world.
Right.
Not just new to your company, it's new to the world.
Right.
And I'm a big believer in the not invented here syndrome, whereby we always love our own children more than anybody else's. We love our own ideas better than anybody else's. And if it's not my idea, I want market proof. I want financial proof that if we put money against this, it's going to work. But that just encourages mediocre ideas, where you can bring, short-term market research, Excel spreadsheet analysis against it. You can do that with mediocre ideas, but for the really big ideas, no way.
Yeah.
You really have to pull back and say, this is a problem. We have insight on the problem and we have a better idea for solving it, and get the activist or management to actually be part of co-creating that idea so that it becomes their kid rather than just somebody else's kid.
Yeah, no, that's great. I think what I've experienced is it leads to more sort of incremental innovation that's very adjacent to what you're already doing. And what tends to get shut down are the bigger ideas, which may be a little more wild and a little more different, but often are the ones that lead to the really significant differentiated new products. So Ryan, if management fails to impress the importance of brand on an activist and they end up slashing the advertising budget, is there anything they can do to minimize the damage? For example, should they emphasize protecting the stronger brands or the weaker brands? What would be the best way for them to make do with less money if they have no other choice?
Okay. Look, if you fought the good fight and you lost, a couple things. The same way you can quantify for every $1 invested in brand, what happens to future sales, you can show the opposite. If we're going to take $1 away in brand, how much should we expect sales to decline? They've already made their decision, but at least let's get that on the table. Here's what's going to happen. Second, if you have a lower ad budget, how do you make the most of it? Well, you would optimize. So we talked a little bit about media mix modeling, which is a resource allocation technique. You take your total now pittance of a spend, and you can optimize by channel for short and long term. Targeting, you would only target audiences that are open to your brand, that has a higher ROI, and you would suppress those households, even in category, that want nothing to do with your brand so that you're highly efficient. In terms of big versus small brands, I think that applies to both. The difference for the smaller brands, I would say, is if you think about brand building and performance marketing, one of the things that we published in the Warwick report, and also we hit on with the HBR, the Warwick report's called the multiplier effect, is brands at different stages of development have a different optimization. If ad budgets are going to get cut and you're a smaller brand, you certainly should put the lion's share in brand building. At different stages of development, performance marketing might be more, but in every stage, what we've been able to prove is brand is a multiplier of performance marketing. And too often, Greg, these divisions are siloed. They rarely talk to each other. The folks in performance marketing are really focused on funnel management and they're episodic, and there's a lot of promotions, which is the quickest way to kill brand. But when you encourage them to use the same positioning and brief as brand builders, it reduces the friction in the funnel and it improves the conversion rate.
Right.
So smaller brands should overemphasize in brand building if you lost the good fight in convincing the activist investors.
So let me add to this, Greg. Let's say that you had a company that had two brands. One was really strong, which in BERA terms means has a high meaning and uniqueness with its target market, and one that's relatively weak. We would say that for the strong brand, if you start with a budget of 100, you should probably allocate 70% of that to exploiting the fact that there are a lot of people who are open to your brand. That would be so-called performance marketing. And 30% of your advertising budget to sustaining the strength of your brand's meaning and uniqueness. Let's say that an activist, you lost the battle with the activist and they said, cut your budget by 30%. You would keep that 30% that's going against sustaining your brand and take it all from the so-called performance advertising. It's the opposite for a weak brand. So let's say that they say, cut your budget by 30%. For a weak brand, you ought to be spending the bulk of your advertising on rebuilding that brand's meaning and uniqueness, 70-30 the other way. If you were told to cut your budget by 30%, take it all away from performance advertising and dedicate your entire budget, 70 now rather than 100, towards brand advertising in order to strengthen its meaning and uniqueness and create people who are open to buying your brand.
The reality is right now, the average firm hasn't figured out the ratio between brand building and performance marketing, regardless of the budget. How do you optimize it? Let alone not understanding that it's not which do I choose. Brand building unlocks that multiplier. So that's really where an activist can really benefit the most.
Well, that's really great. I really like how prescriptive you are in describing this, because I think it gives people something really tangible to think about when they think about their own situation. So I'm going to ask one last question, really, of both of you. And so whether a listener is in management of a company or on a board or is an investor, what is the main takeaway from all this? What is the blueprint for creating value with brand investments?
I think it boils down to eliminate spray and pray. And eliminate hope springs eternal. Eliminate, indiscriminate reach advertising because you're trying to build awareness rather than being very focused on using your advertising dollars and really every touch point you have with a consumer, not just advertising, to build what Ryan described at the very top of this podcast as meaning uniqueness. Key drivers of consumers being predisposed to your brand over other brands and key drivers of your brand's pricing power. And eliminate hope springs eternal. Stop spending money on people, even if they're ready to buy and in the market, that are just never going to buy from you because they hate your brand. It just doesn't hold enough meaning and uniqueness for them. I mean, you could double the ROI of your advertising if you got more granular about who you have a strong brand with and how to get at them with targeted media and avoid media against people that are just never going to buy you.
For me, I would say whether an activist is the client or the CMO, brand, when measured properly, has metrics that matter with high resolution, can bridge the gap between marketing and finance. And you don't wait for the activist. Your playbook should be able to understand brand's contribution to the bottom line. You should be able to measure it in real time. You should be able to manage by audience down to local level. And you should be constantly looking for optimization the same way folks do quarterly forecasts and refinancing. The same discipline can happen with brands. So your playbook should have that gap bridged.
It's like an addition, Greg, to the article you wrote around Be Your Own Activist, where you walk through what it means to be your own activist. You do this, and you do that. And Ryan just described another section, if you like, of that article.
Yeah, I think that's exactly what I was thinking as well. I think the takeaway here is you don't need to have an activist, right? I mean, the threat that an activist might show up maybe gives you a little more of a kick in the butt to take this seriously and not just, pursue the status quo.
Yeah.
But this is the kind of thing that allows you to get an edge over the way many companies are managing themselves so that you're not the one the activist comes after, right? Because you're already thinking so much more.
Yeah, what I really like about your Be Your Own Activist playbook is that you're basically listing potential blind spots that management may have that an activist may see, which creates an opening for them. Well, if you close all your blind spots, there's no opening there.
Yeah, exactly. That's great.
Yeah.
So we've been speaking with Ryan Barker and Ken Favaro. Thank you, Ryan and Ken, for joining us for this very important conversation.
Thank you.
Thanks for having. Appreciate it.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.